Hello, everyone. Thank you for joining this webinar on the UK economy. I'm just going to wait a couple of extra minutes just to give a few more people time to join the webinar. So just starting in 2 minutes' time. Hello, everyone. I'm now ready to begin. Over the next half an hour, I'm going to be discussing the outlook for UK monetary policy. The MPC has surprised many by keeping interest rates on hold so far this year. And although inflation is still going to be above its target for a few more months, I think the MPC is likely to keep interest rates on hold throughout this year. But then as we head into 2019, we'll probably start to raise rates at a faster pace than they have done over last year. So I'm actually anticipating 2 increases in bank rates in 2019 and a further 2 in 2020. So over the next half an hour, I will go through the case for why they're likely to pause for a bit longer than most people expect this year, but then pick up the pace tightening next year. At the end, there'll be an opportunity to pose some questions. If you type a question into the chat box, no one else will see the question or your name, so don't worry about revealing yourself to everyone else. At the end, I'll then respond to the questions in order. So as you can see from this first chart, ahead of tomorrow's MPC meeting, markets think there's very little chance, of course, of a rate hike occurring tomorrow. But investors are pretty unsure as to whether there'll be a rate hike coming in August. As you can see by the black line on this chart, at present, markets see just under a 50% chance of an August rate hike. And up until a couple of weeks ago, I thought that probably August was a good bet for the next rate hike. But the data have just deteriorated quite significantly over the last couple of weeks, which means that I think they'll have to pause for even longer than they originally intended. And then November, although markets seeing an 80% chance of a rate hike by that point, I think that's still overstating things, because by that time, I think Brexit really will be reaching a climax. The government will be making some serious decisions at that time, and there could be a renewed period of market and political instability at that point. So I'm penciling the next rate hike to come in February 2019, as opposed to any time this year. As you can see by this chart, that's therefore a slower pace of tightening this year than anticipated by markets. But then as we go into 2019, I expect 2 rate hikes that year, and that would actually lead to a slightly faster pace of tightening than markets still expect, albeit still a very slow pace of tightening by historical standards. As you can see in this chart already, by this point, after the first increase in interest rates in the tightening cycle, the MPC had already raised interest rates in previous tightening cycles by this point. So we're already at a point where the MPC is delayed for quite a long time, and even 2 rate hikes next year would still leave it looking at a quite subdued pace of tightening by historical standards. So let us review the data that the MPC will be chewing over at its meeting tomorrow. Since it met last time, we've had a round of PMI data, which suggests that the economy still isn't recovering much from the slowdown that we saw in the first quarter. So quarter-on-quarter GDP growth slowed to just 0.1% in Q1, and that seemed to be largely driven by bad weather towards the end of the quarter, where we saw particularly sharp falls in retail sales, for instance, and other consumer services sectors towards the end of the quarter. And so that did seem to be consistent with the idea that this was just a weather-related blip. And the MPC just wanted a bit more time to make sure that there was this rebound coming through in the Q2 data. If it saw growth pick up to 0.4% quarter on quarter in Q2, that was its forecast, then I think that would probably be, or certainly would be encouraging them to raise rates, although other factors are also important. But the PMIs for April, which really should have rebounded significantly, actually were only consistent with quarter on quarter GDP growth of just 0.3%. So falling short of that 0.4% forecast that the Bank of England expects. And of course, the PMI is only a rough guide to growth, and they exclude certain key sectors of the economy. But so far, the official data also haven't supported the case for tightening. In fact, industrial production and construction output both were significantly below their Q1 averages in April. So industrial production was 0.8% below, construction was 1.4% below its Q1 average in April. And therefore, even if we get a bit of recovery in those sectors coming through in May and June, they will still likely subtract together about 0.1 percentage points from quarter on quarter GDP growth. You can see that on this chart, chart 4, which shows you the green bar, and the orange bar there shows both the construction and industrial sectors slightly dragging over GDP growth. If it had just been a weather-related slowdown in Q1, really the April data should have been very strong. We should be seeing rebounds of both those sectors come through. So the fact that we didn't suggests that there's much more of an underlying problem with the economy. There's been an underlying slowdown this year. Now, said against that, retail sales data have actually been quite encouraging, and retail sales volumes look set to be at least 1.5% higher quarter on quarter in Q2 than in Q1. And so that should provide some offsetting support to GDP growth. As you can see also on chart 4, the black bars there show you probably a positive 0.1% contribution to GDP growth from the distribution sector overall. So that will cancel out the drag from the industrial and construction sectors. But even so, that's still then very hard to get a 0.4% quarter on quarter growth rate for the for GDP. It's left up to the non-distribution services sector to do all of the heavy lifting. And so far, at least, we don't have any data for that sector for Q2. But if you just assume that the rate of month-to-month increases in that sector of the economy picks up to above its average rate of the last 12 months, so I've assumed month-on-month gains of 0.15%, which is above the average gain of 0.1% over the last 12 months. So allowing for some rebound in that sector in Q2 as that weather drag fades. Even if you make that quite optimistic assumption, you still only get GDP growth of 0.2% quarter on quarter in Q2. So that the industrial and construction data really are problematic, I think, for thinking that the MPC is going to be in a position to raise interest rates in August. Also, the MPC won't have a full set of Q2 data available for, at its August meeting. They'll actually only have GDP data up until the end of May, so not quite a full quarter's worth of data. And so it won't be possible to come to a very strong conclusion as to what those Q2 GDP numbers will show. They'll only be working under partial information at that point. And given that the April data so far have been weak, I don't see the picture materially being transformed by the time they have their May data at their August meeting. And meanwhile, it's not just the activity data that has been weak. There have been signs from both the labour markets and from the money supply data as well that we get on a monthly basis that I'll come on to in a second. They've also been suggesting that the economy is, again, fundamentally slowing. That Q1 weakness wasn't just due to the weather or any kind of residual seasonality in the data, but it's actually saying something more fundamental about the state of the economy. So if you look at total hours worked in the economy, for instance, as you can see in chart 5 here, hours worked were no higher than they were a year ago. And that's the last time we saw a stagnation in hours worked was 2012, when the economy was really struggling to grow at all at that point. And so as you can see, that data would tend to suggest that we're seeing a further slowdown in the economy in Q2. So the latest data for total hours worked is for April. So again, just pointing to a slight slowdown in Q2. Meanwhile, the money supply data as well also go up to April at this point, and also point to a likely further slowdown in household spending in particular. So growth in the households' broad money holdings has been slowing for the best part of the last 18 months. And that's coincided with a slowdown in nominal spending growth that you can see on this chart. And again, that growth in divisia money, which takes the components of broad money and then weights them according to how likely households are to spend them. So for instance, cash that households have in their current accounts, for instance, that's immediately available for spending, gets a high weight, whereas cash that they say locked away in a one-year savings bond, for instance, is deemed to be relatively inaccessible for spending, and so it gets a very low weight. This measure of divisia money, as you can see, has been quite a good guide to growth in nominal spending over the last 4 or 5 years, and points to a further slowdown in nominal spending growth in Q2. Meanwhile, since the November rate hike, we have seen household savings intentions rise significantly. So even though real incomes may be starting to pick up in the second half of this year as inflation towards the end of this year continues to fall, it's quite likely that households will save a high proportion of their income, as opposed to maintaining their saving rate at its extremely low level. So if you look at chart 7 here, the proportion of households that are reporting that now is a good time to save is actually at its highest levels now since the recession. And as you can see, both these measures of saving intentions fell sharply in 2016, immediately after the referendum, and were a good guide to the fact that households were going to throw caution to the wind and reduce their saving rate, and that was going to provide some momentum to growth in household spending. But ever since that point, we've seen a trend towards rising savings intentions, and that has coincided with a slight rise in the saving ratio as well since a low point at the start of 2017. So going forwards, I think households are likely to be more cautious, and even though their real incomes may be starting to improve a little, they're likely to save more of their incomes, and that to keep growth in spending pretty weak over the next few quarters. And finally, on the GDP side of the picture, we're starting to see now weakness in exports come through. I don't think this has been widely picked up yet, but if you look at chart 8, it shows you that exports in April were, in the 3 months to April, were no higher than they were a year ago. That's the now clearly showing a sharp slowdown from the strong rates of growth in export volumes that we saw last year. So in response to sterling's depreciation, you can see that over the last year we've seen strong growth in exports, and that exceed the rate of growth in advanced economies exports more generally, as you can see by the blue line there. So last year the UK benefited both from an improvement in world trade growth, but also from sterling's depreciation. That boost, however, was pretty small, given that it was imports also had to pick up alongside that too, given that exporters were plumbed into global supply chains. But now you can see that that boost really is wearing off. We're now nearly 2 years on from the biggest depreciation of sterling, so the competitive boost is now really fully worked its way through. And we may now be starting to see signs that supply chains, for instance, are breaking down, that global manufacturers aren't seeking to produce in the UK, given that there's considerable uncertainty over our long-term trade ties. And so in the latest data, we're now starting to see signs that UK exports are underperforming other advanced economies, even though the exchange rate is still very weak. And as you can see, most of that slowdown that we've seen in the last few months is explained by UK-specific factors. Global growth in trade volumes has slowed a little, but certainly doesn't explain the full extent of the weakness in exports that we've recently seen. So there is no support coming through from the external sector at the moment. So really GDP growth is set to be pretty soft. I'm expecting 0.2% for for Q2, so that'd be well below the rate expected by the MPC. Below also the MPC's assessment of its trend rate, and then only a pickup to 0.4% quarter on quarter in Q3, which I don't think would be enough to push them to raise rates in November, given that, as I said, Brexit I think will be in everyone's minds at that point. Furthermore, if we just look at the wage data, we're still seeing no sign of a firming up in inflationary pressure. As you can see, year-over-year growth in average weekly wages, excluding bonuses in the private sector, slowed to just 2.5% in April, having just got up to 3% in March. And the strength that we saw in March, that 3% rate, really reflected the fact that there was this weakness in wages a year or so ago. Actually, 3 month on 3 month annualized growth in wages, which you can see by the black line here, has been slowing for the last 6 months or so. And this measure of wage growth is significant because the MPC specifically referred to it last year when it built the case for raising interest rates. And you can see the strength of it consistently above 3% in the 6 months or so before they raised rates really pushed them to press ahead with that rate hike in November. But since then we have seen a significant slowdown. And really, if you look back over the last 4 years, there hasn't been any improvement in the trend. It's just been steady. Wage growth has just been oscillating really around a 2.5% rate. There's still not really convincing signs that we're still we're about to reach a turning point there. So again, the latest slowdown in wage growth certainly will be knocking the MPC's confidence that we're going to see underlying price pressures firm up soon. Now, the one awkward factor for the MPC over the next few months is that CPI inflation probably will pick up a little bit over the next couple of months. So as you can see here on this chart, it's currently at 2.4%. That's the latest data for May. But in June, I think it will rise to 2.7%, which will exceed the MPC's latest forecast by 0.2 percentage points. So that's the latest data that the MPC will have at its key August meeting. And so, although the activity data have been on the softer side, the inflation data have now started to, will start to surprise to the upside. But that upside surprise really will be driven by higher oil prices. So the MPC made its May inflation forecast based on oil prices near to $70 per barrel, rather than the $75 plus that level that we've seen recently. And so, as you can see on this chart, the light green bars here show you that the contribution to inflation for motor fuel is set to pick up quite significantly in June, and that will help to drive up the headline rate to 2.7%. By and large, the MPC can look through those sorts of commodity-driven pickups in inflation and instead focus on the underlying core inflation picture. And core inflation should continue to fall over the next 6 months or so. There could be some volatility in the data in June, but we should continue to see core inflation come back down and probably fall below its target next year. So chart 11 here shows you that inflation in the core goods sector has been tracking past movements in sterling very closely over the last few years. So you can see here sterling is advanced by 12 months. So you get quite a good indication of where core goods inflation is heading for up to a year ahead, just based on what's already happened to the exchange rate. There are delays in the delays between importers seeing higher costs and that being finally passed on to consumers in the shops. So as you can see here, the black line is core goods inflation. Currently, it's just a bit below 2%, but by the end of this year, it should be back down to about 0 on the basis of past form. And that should subtract, given that core goods has a roughly 30% weight, that further fall is about to subtract about 0.6 percentage points from the headline rate of inflation. So that gets you below the 2% target, given that we're at 2.4% right now, provided everything else stayed constant. Now, as I said, energy's contribution to inflation is set to rise a bit, so we're not going to get to below 2% rate of inflation until midway through 2019. But on the core measure, we should start to see a below 2% rate come through, perhaps towards the end of this year or the start of 2019, given that core goods inflation is set to fall sharply as we see here. And inflation in the services sector still isn't really rising significantly. I think it is on an upward trend, but the trend is so mildly upwards that it's going to take a very long time before it really starts to trouble the MPC. So on this chart, we can see what I've termed underlying services inflation, which is the CPI services index, but I've taken out transport services, which are very volatile and of course influenced by the oil price. So that includes airfares, which are particularly volatile from month to month in the CPI. And I've also excluded education costs and rents, which are the two categories which are heavily influenced by government policies towards, say, tuition fees or social rents. So again, they don't really reflect much about the underlying state of the economy, so I think it's worth stripping those sectors out. And as you can see on this chart, services inflation on this underlying measure has been slowly rising over the last couple of years, indicative of a gradual tightening of the labour market, a slight pickup in wage growth. But it's been rising only very gradually, and it's only at 2.4% in the latest print, which is a clear or full percentage point below its average in the pre-crisis, in the decade before the 2008 recession, as you can see by the dotted line on this chart. And on its gradually rising trends here, which you can see, it would take another 4 years to actually get back to that 3.5% rate. Of course, core goods inflation, which we saw earlier, it looks set to come back to about zero rather than sort of the persistently negative rates that we saw in the decade before the recession. And so that is significant because that sort of lowers the bar a bit for services inflation. If it got up to 3.5%, and that would be consistent with a core inflation rate a bit above 2%. So the MPC is not going to be allowing services inflation to get back up to that rate. But with core goods inflation at about zero, and that's clearly where it looks like it's heading, given the fact that we've seen stability in the exchange rate over the last year, you can still allow services inflation to get up to 3.25%. That's the rate that looks consistent with a 2% core rate. And so we're still a long way from that point, given that the latest data are just at 2.4%. The trend is clearly rising only very slowly. It would take another 3 years to get to that level of services inflation that would be consistent with core inflation at 2%. I think it's just worth stepping back as well and looking at the global picture, where by and large there's still very little underlying inflation pressure. So looking at chart 13 here, we can see the average rate of core inflation in G7 economies. The latest rate is just 1.6%. It hasn't been above 2% since 2008. And I think there's no reason to expect UK core inflation to be persistently above the G7 average once the sterling effect is fully faded. As I say, I think that sterling boost to the inflation numbers will have fully faded out of the data by the end of this year. In which case, there's no good reason, I think, to think why core inflation would be stronger in the UK than in other G7 economies. Yes, there's slightly less labour market slack, but it hasn't been a decisive impact so far, and I don't think that's suddenly going to change. So the inflation data aren't going to be breathing down the MPC's necks like it was at the tail end of last year, when a series of upside surprises forced them or persuaded them to raise rates in November. So that's why I think overall the activity data are going to be weak. Inflation is going to still be coming back down quite quickly to the 2% target. There's a bit of a blip to come through in the latest data that will make things a bit tricky, a bit presentationally awkward for the MPC. But I think the pronounced weakness of the activity data is enough on its own to persuade the MPC to keep rates on hold throughout the rest of this year. 2019, though, could be a different story for several reasons. So first of all, I think the fiscal consolidation, which has been ongoing for almost every year since 2010, can finally be paused for a couple of years. and fiscal policy won't be dragging on GDP growth. So chart 14 here shows you the government's the official projections for cyclically adjusted borrowing. Now this is what the Chancellor is trying to target. His fiscal rule is to get cyclically adjusted borrowing down below 2% of GDP in 2020. Now on the current fiscal forecasts, he's actually set to get that borrowing figure down to 1.8% of GDP, as you can see here. And the fiscal plans incorporate further tightening measures in 2019 and 2020. That means that this fiscal headroom that you can see here opens up. He should get, if he implemented all of those consolidation measures, then by 2020 the OBR thinks that borrowing would be down to just 1.2% of GDP. That leaves him 0.8% of GDP headroom to potentially, he could potentially utilize that scope to borrow a bit more and soften the fiscal plans. And actually, so far this year, it's still very much early days. We don't have much data for this financial year yet. But so far, at least, it looks as if borrowing is going to be coming in below the OBR's forecasts. So actually, the borrowing total for 2017-18 has been revised down a bit, as you can see here. So it's a lower starting point. And then the April data looked very good for public borrowing, and gilt yields have fallen more than been incorporated into the plans, and so the government's borrowing costs are set to be lower as well. So actually, borrowing this year is probably going to come in a bit below their forecast on a cyclically adjusted basis, as you can see there. So there's plenty of scope with borrowing already below the government's target that it needs to reach in 2020. There's already scope for them to soften the fiscal consolidation. And the Chancellor has indicated, has hinted several times that he will utilise this fiscal headroom at the budget towards the end of this year. So I think it's reasonable to assume that there actually could be a small fiscal boost coming through in 2019-20. As you can see on this chart, there's not huge scopes for a fiscal giveaway, but clearly with borrowing already below the limit in 2018, they can borrow a little bit more. Particularly given that, as I said, gilt yields have fallen, that's also opened up a bit more scope than they thought to borrow and to spend on day-to-day expenditure. So actually, I think fiscal policy could be slightly stimulatory for growth. We haven't seen that since 2014. That was the only other year in the last decade that we've actually seen fiscal policy support growth. And that boost there was deliberately timed to support the economy ahead of the 2015 general election. It's very clear that the government alters fiscal policy and the stance to try and improve electoral outcomes. And I think it's interesting to note that the year in which we've seen strongest GDP growth was 2014-15, the only year of this decade to have seen a loosening of fiscal policy, whereas years in which we saw very significant fiscal consolidations, that really helped to drive down GDP growth. So in particular, at the start of this decade, a promising recovery was then brought to, it was significantly slowed in 2011, 2012. So this is something going to be transformative for the economy, but it should at least help support the economy a modest amount. As you can see, this year fiscal policy is still set to be a drag on growth. But next year, as I say, there should be a little scope to be stimulatory. So we're probably looking at a 0.3% boost to GDP growth, I think, compared to a slight drag this year. Now, I think the other major reason to think that the economy should be recovering next year is that towards the end of this year, there will be a decisive decision made on Brexit, and I expect Theresa May to ditch plans that she currently has to leave the customs union, to ditch them because they're unworkable, because they're unpopular with public opinion, and because Parliament probably wouldn't vote for them. Now, this table, I don't intend to go through all of the different scenarios here, but hopefully this will be a useful reference for you. And this goes through all the different potential outcomes for Brexit. Now, at the moment, the government's official policy is going, or they intend the official policy to be one of these two options here, which I've just highlighted, which is clearly a hard Brexit route. Theresa May currently intends to leave the customs union, but to try and minimise the disruption through one of these two options, either the max FAC option or customs arrangement option, which have been detailed already and is currently being discussed by the cabinet. The cabinet is clearly very split on this and haven't reached an agreement. They intend to try and reach an agreement in the start of next month, but it's very unclear whether that will actually any meetings there will actually come to anything before Parliament goes into its summer recess. But I think it's much more likely that rather than just going down this hard Brexit route and leaving the customs union, Theresa May will have to change tack towards the end of this year and will seek to go for one of these other two options that I've got set out on the right hand side here. So the first option there would be to leave the single market but stay in the customs union. And the second one would be just to go for the soft Brexit, where you stay in the EEA and you accept all of the rules that are involved with that, or that you just continually delay Brexit via different mechanisms and you have a never-ending transition period, which is effectively like a soft Brexit. You effectively stay in the EEA, so you're still a full member of the single market and fully within the customs union, but you have no real say on the rules of the club. Now, I think it's quite hard to say which one of these ones she's going to go for, but there are certain factors that are tipping her, I think, towards making a pivot towards a soft Brexit towards the end of this year. And of course, she's been continually delaying making this decision as a means to keep her party together. But by the end of this year, she'll have to make a decision one way or the other, whether she's in or outside the customs union. There's no halfway house as well. So the EU has been pretty clear that the two options that are currently being considered by the cabinet, that neither of them really would work. It's still trying to essentially is another form of cherry picking, trying to have being outside the customs union but still maintaining some of the benefits. The EU is very clear that you're either in or out the customs union, and I think it will clearly rebut any of these proposals if the UK government finally decides which one it thinks is the best option. And in which case, Theresa May will have a stark choice of whether being properly outside the customs union or fully inside it. These halfway houses that are being discussed at the moment just aren't practical options. So I think at that point she will go for staying in the customs union, because for a start we've seen a clear shift in public opinion now over the last year. As you can see on this chart, for the first year or so after the referendum, there was a consistent majority of people in line with the referendum result saying that they thought the Brexit vote was the right decision for the country. But over the last year, we've seen a turnaround in that, and now a consistent majority of people saying that actually it was the wrong decision. There's a majority that has regrets now. And the Conservatives will ultimately respond to public opinion. They're in the business of trying to win general elections rather than having highly principled views on the UK's relationship with the EU. And Theresa May will respond to public opinion. She initially went down the hard Brexit route and was threatening a no-deal Brexit and saying that would be perfectly manageable for the country, when there was a consistent majority of people saying Brexit was a great decision. Now, however, over the last year, we've seen her consistently tear up her red lines and soften her stance in response to the shift in public opinion. And I think that is going to continue to guide the Conservatives down a more soft Brexit route. Furthermore, this applies more to the single markets and whether you want to stay on that or not. But since the referendum as well, we've seen a very sharp fall in the percentage of people saying that immigration is something that the country should focus on and the government should do more to control. So this is a Ipsos Mori survey that is conducted every month. And you can see here that at the time of the Brexit referendum, concern about immigration was extremely high. Nearly 50% of people said is one of the two most important things that the government should focus on, whereas now that's down to just 20% in the latest data. Very sharp fall, whereas other issues such as funding for the NHS, for instance, has suddenly shot up as a much more important thing for the government to focus on. So not only has concern about immigration fallen, but the sorts of drivers that were pushing towards people to vote for Brexit are no longer so much in the forefront of people's minds. And the further we get away from the Brexit vote, the less the public, I think, is going to care about all the specific details of Brexit. In which case, Theresa May can go for Brexit in name only, something that sounds like Brexit, but doesn't really, if you look at the details, doesn't really lead to much fundamental change. I think Theresa May will also be quite encouraged that over the last year, she's made a series of Brexit compromises. We've got a transition deal where nothing really changes. She's told people that they're going to have to continue to accept some form of oversight from the ECJ, that immigration is still going to have to be a part of daily life, and that there will need to be still further big financial contributions for quite a long time to come. She told the electorate all of that, and yet her popularity rating has actually strengthened a little bit over the last 6 months. As you can see here now, she's actually slightly favoured more than Jeremy Corbyn by the electorate. Neither are popular, but actually her popularity rating hasn't been hit at all by a series of compromises towards the EU. And again, I think that would be encouraging her to, rather than go down the hard Brexit route, just implement minimal changes and go for a soft Brexit. Now, of course, she may be worried that if she tacks towards a soft Brexit and just goes for the simple option and doesn't try and leave the customs union, then she might be attacked by Eurosceptics within her own party. At the start of this year, we saw just over 60 Conservative MPs sign a public letter saying that Theresa May should stick to the course that she outlined over a year ago and go for the hard Brexit. And it only takes 48 Conservative MPs to sign a letter demanding a confidence vote for one to be held. So there are potentially enough Conservative MPs out there to trigger a leadership election at some point. But before the overall party gets to have a say on the Conservative leader, MPs have to vote first. And it's a simple confidence vote in Theresa May. If she gets more than 50% of MPs to continue to support her, then she stays as leader. And that's actually therefore quite a high bar for the Brexiteers to actually overcome, to then trigger a leadership election, which might actually lead to a Brexiteer taking power. Because I think most Conservative MPs would be very fearful of any instability and anything that potentially increases the risk of another general election, given that the polls certainly turned very sharply against them last year, and many of them have very small majorities now. I think most of them will be prioritising stability over trying to change the leader, particularly over this period of instability. So this is a particularly high bar, I think, for the Eurosceptic MPs. And I think it's even doubtful whether they will get enough signatures together if Theresa May did make a pivot towards a soft Brexit. Given that many of those 60 or so MPs have very small majorities themselves. And as you can see here, for instance, I've looked at the majorities of each of those 60 hard Brexiteers and how, for instance, nearly 20 of them would lose their seats if there was a swing in support at another general election of up to 5% towards the opposition parties in those seats. Many of them, therefore, are quite vulnerable to another general election. And it only makes sense for them to try and trigger a leadership election if they think that they can then have a general election, which would then increase the government's majority and then enable them to go down a more hard Brexit route. At the moment, the maths in Parliament are the real constraint, and just changing the Conservative leader doesn't do anything to improve that. What you really need as a hard Brexiteer is to have a leadership election and then a general election that then gets you towards the hard Brexit. But as I say, I think many of those hard Brexiteers actually will be quite fearful of another general election, given that their majorities in many cases are quite small. So let's just suppose then, and of course it is a big if, there are many Brexit scenarios. It could be that there's a longer period of uncertainty and the Article 50 deadline just gets postponed and postponed with the agreement of EU members. But I think it's reasonable to assume that towards the end of this year, Theresa May will have to make a decision and she will veer towards a soft Brexit, which I think could then lead to some catch-up spending in business investments. Since the Brexit vote, there's been, firms have been extremely cautious when it comes to investing. Investment actually has risen a bit. It was up 2% last year, but it really should be racing away given that profit margins are very attractive at the moment, particularly in the export sector. The cost of capital is very low and credit is widely available. If you look at other G7 economies, business investment was up by more like 5% last year, as continuing to see strength this year. Firms have certainly been saving more. So if you look at chart 21 here, the blue bars here show you the rate or the amount that they've been adding to their cash stockpiles. And the black line shows you the stock of that cash as a share of GDP. Now, as you can see, it's been on a long-term rising trend here, and there are many other factors at play. But the upward trend has certainly strengthened in the last couple of years, a bit in the run-up to the Brexit vote, and then further as the companies reacted to the referendum decision. So I think there is cash waiting on the sidelines to be deployed if there was a soft Brexit and there was some clarity going forward as to the UK's relationship with the EU. And the sums here are quite significant. So if you look at the stock as a share of GDP, it's now up to 38%. So even if you say there's a long-term rising trend at play, there's still perhaps scope there for a boost to GDP of, well, I don't think it'd be this huge, but you can see there's perhaps a 3% of GDP excess in cash saving by firms that could potentially be spent. Now, it's unlikely that any Brexit deal is going to fully reduce Brexit uncertainty. There's still likely to be uncertainty about our future trading relationship. It could be that we're just in a never-ending transition period as opposed to a full pivot towards a soft Brexit as a sort of final solution for Brexit. I think it's perfectly possible that we just have a series of transition deals and the can keeps getting kicked down the road and we never really get to a Brexit. And in that scenario, then firms will still have to be pretty cautious about making investments because they will only have 2 years ahead as some visibility. But even so, I think, as I said, the numbers here are pretty significant. We could really see very strong growth in business investment if there was a pivot towards a soft Brexit towards the end of this year. So as a result, those two factors together, I think, both a modest fiscal boost and also catch-up growth in business investment, those two factors, I think, could really drive the economy forwards in 2019. And so I've got GDP growth picking up to 1.7% year over year from 1.2% this year. Now, the MPC's estimate of trend growth is around 1.5%. So, and given that it thinks already the economy is broadly at its potential level of supply, then it will be worried about a period of excess demand pushing inflation up over the medium term, even with growth at just 1.7%. And although, as we looked at earlier, CPI inflation, I think, is likely to be below 2% in 2019, that doesn't have to be an outright barrier to rate hikes. Actually, if you look back to the 21 occasions in the past when the MPC has raised bank rates, 19 of those hikes have occurred when the core CPI inflation rate has been below 2%. So the MPC doesn't place too much emphasis on the current rate of inflation. It's much more concerned about where it's likely to be in a couple of years' time and whether we're likely to see a period of excess demand growth or not. And as I said, anything above growth of 1.5% in the economy in GDP next year would be enough, I think, to persuade them of the case for raising rates, even though the headline inflation data could look quite weak. And it's also, I think, worth drawing a parallel here between the UK and the US. When the US started its tightening cycle, core inflation was below the target. The current rate of inflation doesn't need to be an outright roadblock or the ultimate determinant of whether the MPC hikes rates or not. It's that prospect of above trend growth that will be, I think, be driving their decisions the most. So just to recap before I go through the questions that have been submitted, I think GDP growth is simply going to be too weak for the MPC to hike rates this year. And looking to tomorrow's MPC meeting, the data has been so weak that I think it's going to be very hard for them to support current market pricing of a near 50% chance of an August rate hike. there's not going to be any strong steer in there of an imminent tightening. There's no data they can point to support that case. And actually, I think it would be interesting to see whether there are any more dovish comments come through, or whether they, for instance, soften the line that they had in the May set of minutes, which talked about an ongoing tightening of monetary policy. That might be just putting too much emphasis on the prospect of a near-term rate hike for their liking, given the fact that the data have been so weak. Looking at the inflation outlook, I think it's likely that inflation will fall below the 2% target in 2019, but that doesn't need to be a factor that rules out tightening altogether next year. Because, as I said, GDP growth should get some support both from fiscal policy, which will be loosened for the first time since 2014, and also a reduction in Brexit risk as the government finally makes a decision towards the end of this year and pivots towards a soft Brexit. That should spur a decent revival in business investment. So while the MPC, I think, likely will keep rates at 0.5% for the rest of this year, I see 2 rate hikes coming in 2019. I penciled those in for February and August, but I accept there could be some slippage there. They may need to wait till May to see that recovery in business investment, for instance, come through before pressing ahead with the first hike. And of course, a February hike would be just before the end of the Article 50 period. The uncertainty may continue right up until the wire. Negotiations may go right up until that March deadline, in which case, a May rate hike would look more likely. But I think if there was that pivot towards a soft Brexit, they would be concerned about that they got behind the curve, that has left rates on hold for too long. And I think would therefore still push through 2 rate hikes in 2019. And then again, I see a similar pace of tightening being likely in 2020 with 2 rate hikes. So that would leave bank rates at 1% by the end of 2019 and 1.5% by the end of 2020. Okay, so I hope you found all that useful. Apologies if I skipped over anything too quickly. I'll just have a look at the questions and respond in a second. Okay, so the question is, why are markets still pricing in, a near 50% chance of a rate hike, even though the data have been as weak as they have been in the last couple of weeks? Well, I think it's just that markets have not reacted enough to the latest data. This is exactly what we saw in the run-up to the May meeting, that we saw both inflation and GDP data surprise to the downside, and yet markets didn't price out quickly enough the chances of a May hike. They, I think, still have not reacted enough to the data that have come in over the last couple of weeks. In particular, that industrial and the construction data were just weak enough to suggest that we're only going to get 0.2% or so for GDP growth in Q2, which would certainly put the dampeners on another rate hike in August. The MPC try and suggest that an August rate hike was likely in May. It was certainly emphasising and trying to look for the positives in the latest data, and for trying to argue that it was just a temporary slowdown. But in order to support that story, the data really had to rebound in April. So that's a real problem for the MPC's narrative about why the economy has slowed recently. That you can no longer say that the data are weak just because of snow effects or perhaps because of some seasonality problems with the data. It's that the April data are a real challenge to that view. So I think markets are probably placing too much weight on MPC members' comments before that data came out, and that I think we'll know tomorrow to what extent that was a game changer for their thinking. But I think we'll see more dovish comments come through. So I had one more question about the Brexit process and what milestones would I be looking out for to tell me that a soft Brexit is being realised? Well, the turnaround is going to come towards the end of this year. Now, I don't think we're likely to get much warning. I think it is likely to be a compromise that Theresa May feels she has to make at an EU leaders summit towards the end of this year. Now, there are hopes that Brexit would be largely finalised, or at least some agreements for the direction of travel after the transition period. Let's hope that that would be agreed at the October meeting of the EU Council. Now, that seems highly unlikely given that the UK government is still struggling to come together with its proposals, and they haven't really been discussed yet in detail with the EU. And as I said earlier, both the max FAC and customs arrangement options, which are trying to minimise the disruption of being outside the customs union, have been dismissed so far as being unworkable by the EU, and it doesn't resolve any of the problems around Northern Ireland as well. So both would still lead to some, even if they were practically possible, both would still have there would still be some residual issues around the full alignment of the Northern Ireland economy with the rest of the Republic of Ireland. It wouldn't fully solve the problem of maintaining the status quo in Northern Ireland, which is what the UK government has committed to doing. So I think it's likely that rather than there being a turning point in Parliament, I think it's likely that Theresa May will decide, and as an EU leaders meeting, that she has to make this decision. I don't think the cabinet is likely to agree on any of these two options in the next couple of weeks and be able to put the option to a vote in Parliament by July, as again had been hoped originally. The Parliament is set to go into a 6-week-long recess in the UK from July the 6th. So that's only 2 weeks away now. I think there's simply not enough time to try and square out all of the disagreements within the Conservative Party. And Theresa May, has consistently kicked the can down the road on lots of these issues, and has always been trying to preserve party unity by not making any decisions. I don't think there's going to be a turning point in the next 2 weeks that Conservatives suddenly find some unanimity on one particular option. In which case, the Brexit, I think, is going to trend along with no real progress for a couple of months while the Parliament is away, whilst MPs aren't all together. And MPs will not get to vote on the government's Brexit options. I think it's much more likely that Theresa May turns around at a EU leaders meeting and realises that leaving the customs union isn't practical and can't be achieved, at least in the next few years. And that's the turning point. I think actually it may avoid a kind of key vote in Parliament on the customs union issue, because the Conservatives won't be organised enough to get that through Parliament and to put it to them before they go to a key EU meeting. And I've had just one more question about the outlook for gilt yields in light of this tightening that I anticipate. So I think over the next 6 months or so, gilt yields are likely to remain very low, given that actually the MPC is probably likely to disappoint market expectations of a rate hike this year. It will take the edge off gilt yields a little bit. And furthermore, continual uncertainty and continued delay in the Brexit negotiations, I think, is going to make people anxious. And the fact that there won't be any clarity coming through in the next few months, I think, is going to lead to perhaps some more weakness in business investment, more deferred decisions over the next 6 months. And again, is a reason why the MPC is not going to just delay in August, but delay also in November, starting the tightening cycle. So in the near term, it's hard to see gilt yields, I think, rising from their current levels. But as we head into 2019, then I think there's scope for a pickup in gilt yields certainly to come through. So my forecast for the 10-year yields at the end of 2019 is 2.2%, which is clearly above current levels. But that is obviously conditional on a soft Brexit and that improvement in the UK's medium-term growth prospects. I think ultimately the MPC, if we do get that soft Brexit, is heading towards a level of bank rate, a neutral level of bank rate of 2.5%. So certainly a lot lower than it was pre-crisis, but also higher than I think is currently factored into the gilt yield curve. So um, this is of course conditional on a soft Brexit and no hit to the economy from Brexit as a result. But if you then plumb that in and assume that they continue hiking, let's say a 25 basis to 25 basis point rate hikes every year until you get to 2.5%, then that would point to a 10-year yield next year of around 2.2%. So certainly clearly a lot higher than we are right now. I'll just stay here for a couple of minutes just to give you a chance to ask any more questions if you have them. Okay, so I just had one more question about the outlook for the housing market. Now, I think the fact that the MPC, I think, is likely to defer raising interest rates in August and November means that there's a bit of support to the housing market to come. I think mortgage rates are now likely to only edge up over the next few months rather than rise significantly, and in which case, that should at least help to support house prices around their current levels. But going into 2019, if the MPC then does raise rates twice, that's really going to keep the housing market depressed. Loan to income ratios for first time buyers, for instance, are at a record high. So you only need fairly small increases in mortgage rates to really affect the amount that households are able to borrow. So leverage is just so high in the housing market now that fairly modest increases in mortgage rates really do affect the amount that people can borrow. Now, there are some things that households can do to keep their mortgage interest payments low, even though rates are rising. They can, for instance, continue to extend the term of their mortgages. So now we're increasingly seeing 30-year mortgages being common as opposed to 25-year mortgages. So that could continue to mitigate the impact of rising mortgage rates. But ultimately, I think we're looking at a period of house prices rising at a slower rate than incomes because leverage is high and mortgage rates are slowly rising. There's not an easy way around that. I think this is what policymakers ultimately are trying to achieve as well, is bringing house prices back down a bit more in line with incomes after a period in which they've grown at a vastly faster rate. I think policymakers are going to be trying to keep house prices in quite a narrow range of 0 to 3% year-over-year growth. Below that, then households' confidence starts to get hit and they need to ease off the pace of tightening. But anything above that, then they'll be worried about financial stability risks and, again, excessive leverage. And so I think they're aiming now, really, both the government and the MPC for only very gradual increases in house prices. That would be their managed solution. And I think that's quite likely, given that we'd only get, as I say, it only takes fairly modest increase in mortgage rates now to really affect the amount that households can borrow. So a period of subdued growth in house prices, I think, is the most likely outcome. Equally, it's very hard to see house prices falling outright for a sustained period anyway, given that the labour market is healthy, unemployment rate is extremely low, few people are being forced to sell their houses as a result of losing their jobs, for instance. And so what what has happened over the last year is that although demand has weakened, supply also has contracted very sharply, and so that's helped underpin prices. And really, to get prices falling, I think you'd need to have that to be driven by weakness in the labour market. And although surveys of firms' employment intenders have weakened over the last 6 months or so, they're still consistent with unemployment stabilising at just above 4% where it is at the moment. So until that changes, I don't think that's likely. That house prices will have a firm floor. Okay, everyone, I think that's all the questions. I hope that was helpful. Please do feel free to get in touch and email me with any questions you may have as well throughout the year. I'm very happy to respond or pick up the phone and have a conversation. Okay, thank you.